Hey, I just wanted to take a minute here and go over the leaked version of the Trump tax reform plan that came out today. It's September 27th, and this is the 9-page paper that kind of does an overview of what the administration wants to get out of Congress. Of course, the final version, if any, that is actually passed by Congress will, I'm sure, be different. But just to go over what we do have, let's take a look at what's going on here. So the tagline is more jobs, fairer taxes, and bigger paychecks. And is that true? Well, kind of. Like anything in politics, it's all in the details. A bunch of introductory text, which doesn't really mean anything. And so here, this is the two big things on the individual side that they're pushing. And you'll hear in the media reports that they're doubling the standard deduction, to 24,000 for married filing jointly or 12,000 for a single. So is this true? Well, not really. Reason being that the current year standard deduction is 12,100 for a married filing jointly couple. But if you read down here, let's see. To simplify the tax rules, in addition to the standard deduction, and personal exemptions for the taxpayer and spouse are consolidated into this larger standard deduction. So what does that mean? Well, if we look at a pro forma kind of tax return, we've got Joe and Jane taxpayer here. They're making, median amount of income, 54,000 or so, and they're married filing jointly. And you look over here, on the 1040, we have the itemized or standard deduction. So this is the standard, 12,600, and but then we have this line down here. This is 8,100. That's the personal exemptions. So for every person in the household, you're given $4,050 for 2016, anyways. Changes a little bit every year. So what they're saying here is that the 24,000 is going to replace the combination of these two things, not just the 12,000. So 12,600 plus 8,100 is 20,700. Okay, so we're not going from 12 to 24. We're going from 20, or almost 21, to 24. So it's a little bit of an increase, but not the doubling that they're talking about. So we go over. So what else does this say? Let's see. There is an elimination. I can't remember where they put it. There's an elimination of most of the itemized deductions because you're getting quote-unquote double, right? They're still going to do... oh, here we go. In order to simplify the tax code, the framework eliminates most itemized deductions but retains tax incentives for home mortgage interest and charitable contributions. Okay, so, how does that compare to the current... current plan? So we go to a Schedule A, and we say, okay, what's on there now? So we've got, health expenses, medical and dental expenses above 10% of your income, or 7.5% if you're a senior citizen. You've got your income taxes or sales taxes, depending on, what state you're in, if you have an income tax or not, and it goes whichever one's higher. Your real estate taxes, personal property taxes, and then here's your home mortgage interest, along with mortgage insurance premiums and similar things if you qualify, charity, casualty losses, which hopefully doesn't happen to you, and then the miscellaneous and the on-the-job kind of expenses. So under the current system, if you are a married filing jointly couple, then you have to exceed 12,006 in order for those itemized deductions to start counting, which if you have a mortgage typically isn't that hard. So maybe you have I don't know, let's say you have $6,000 of mortgage interest, your real estate taxes are $2,500, your state income taxes, it's going to vary widely. It could be let's stick with that $2,000 number that they have here. It's sort of an auto calculation. You give $1,200 to charity, you donate some clothes, say $500 there, and already we're at 12.2. Okay, so if you have any kind of on-the-job expenses, those begin to count. If you have health expenses, those begin to count. If you have a larger mortgage, obviously that sways the numbers. Or if you give more to charity, you know, that all is going to reduce your tax burden. But now, if all these go away, and this goes to 0, and okay, charity's going to stay. Now you can see that getting to 24,000 is going to be really hard. So pretty much, you know, I would say the vast majority of taxpayers are going to be filing just this $24,000 deduction. Okay, so that's the itemized stuff. And then let's go back up here. They want to change the rates. Instead of having the 7 brackets of, what is it, 10, 15, 20, 25, 28, 33, 35, and 39.6. They want to simplify it down to 12, 25, and 35, which is going to be, it's going to work out pretty much the same, probably as like a blended average. So that's not going to be that big a deal. And let's go down here a little bit. Enhanced child tax credit, middle class tax relief. They want to increase the child tax credit, and the first $1,000 will be refundable, which means that even if you don't owe any taxes, they'll still write you a check back as a refund for up to $1,000 per kid. Currently, there are income limitations and things as far as how much child tax credit you get. So if they phase out those limitations and increase the total size of the child tax credit, that'll be a big win for people with kids. And then they're talking about they also want a non-refundable $500 credit for non-child dependents. So if you have other people living in your household, like you take care of your elderly parents and they're living with you, or some kind of other, usually family relations, that'd be a nice little bonus. This is non-refundable though, so if you this is only counts against a tax liability that you already have. So a Joe and Jane taxpayer here, if this all changes, when this goes down to 0, so they made 54, they're taking the $24,000 deduction. They're going to owe a net of $3,500, and then we start subtracting from there with the credits. So, if they have an adult dependent in their house, then 500 of that will get taken off, which will decrease their tax, increase the refund, and so on. Individual alternative minimum tax, they're saying they want to get rid of that, which I think is actually a great idea, because AMT is a little bit ridiculous. It's like, well, you made too much money, so you have to pay more taxes just because. Even though you're entitled to more deductions, but AMT says otherwise. And this one's pretty vague. The work, education, retirement framework retains tax benefits that encourage work, higher education, and retirement security. So I'm guessing that the higher education is going to be the education credits. There's 3 different ways that education can benefit you in your tax return. There's the tuition and fees deduction, there's the American Opportunity Credit, and then there's the Lifetime Learning Credit. Retirement security, there are deductions for contributing to your 401ks, IRAs, and then if you make under certain amounts, then there's also an additional credit for retirement contributions. And retains tax benefits that encourage work. That's a little vague. I'm not quite sure what they mean there. But they want to simplify these benefits to improve their efficiency and effectiveness, which is what they always say. So who knows how that'll turn out. And other provisions, they want to get rid of a lot of deductions and credits, which I'm not a fan of. I always want more deductions, more credits, more exemptions, because I want everybody paying less taxes. It's just my personal preference, but they're saying they'll make it up with lower tax rates, but we'll see. Repealing the death tax and generation skipping transfer tax. Personally, I think this is a good idea because, all that money was already taxed. So taxing it again, I think, is sort of like a double jeopardy for your money. In the business stuff, this is kind of interesting. So they want the maximum rate for sole proprietors, partnerships, S-corps to be 25%. So my reading of that is that even if you're in this new 35% rate, then the money coming to you through your S corp, let's say, is going to be taxed at 25%. So that would be a huge win for people who have successful sole proprietorships, partnerships, and S corps. Um, that'd be good. Reducing the corporate rate to 20%, which I think is a good idea. You always want corporations keep more of the money that they earn, and then they can reinvest it or deploy it or pay it out as dividends or what have you. And expensing of capital investments. This would be super interesting if this were to pass. So basically, under current rules, you buy something that has a large or a long lifetime. You don't even though you spend the money in 2017, let's say, you spent $1 million on an MRI machine or something. You don't take the full expense of that in the current year. You take a part of it each year, and there's different rules depending on what type of asset it is and that kind of thing. But if you can expense the whole thing right away, then great. The flip side of that is that they want to limit the interest expense. So normally these capital investments are things you get a loan on. So very few, let's say with the MRI example, very few medical offices are just going to go out, use cash, buy an MRI. Typically, they're going to get an equipment loan, and then they borrow the money, they buy the machine, and then they have payments on it. They have the principal and interest payments, and then that interest is deductible under current rules. So what they're saying here is that because they're giving you the whole write-off up front, then they're going to limit how much of that interest you can take, which I think is fair. And other business deductions and credits, they want to basically eliminate some of the deductions and credits. That's basically what they're saying. Domestic manufacturer kind of stuff, R&D. So they do want to preserve the R&D and the low-income housing credits, but it looks like everything else they pretty much want to get rid of. And the argument is that, well, the rates are going to be lower, so you don't need the credits. If that ends up passing, then you have to wonder, those rates can change. A future administration can do something else. So, it's a little bit of a risk there. And then there are special rules for various industries, so they want to modernize that, whatever that means. Probably if history's any guide, that usually means raise taxes on those industries. So then they want to limit offshoring and shipping jobs overseas and all that kind of stuff. And that's more of a political thing than an economic thing. But yeah, that's the proposal. So I just wanted to give you an overview from a tax perspective, and try to. My biggest pet peeve is when they talk about doubling the standard deduction, because they're not. So you have to be aware of what's really going on. Anyway, hope that helps.